Welcome back to the Pro Ticker Podcast, your Friday morning edition covering major financial magazine headlines, everyone.
It is good to be back. And frankly, looking at the terminal this morning, I don't think we could have picked a more volatile Friday to try to make sense of, well, any of this.
You are not kidding. I was just organizing the stack of reports we have to get through today. We're pulling fresh ink from CNBC, Bloomberg, Yahoo Finance, and The Street. And it feels less like a news cycle and more like, I don't know, months worth of panic crammed into 12 hours.
It certainly feels that way. I mean, we've got a looming Federal Reserve announcement that could fundamentally redefine how we think about money, a potential government shutdown clock just ticking away.
A massive divergence in how Wall Street's trading big tech, and a commodities crash that has left the gold bugs absolutely spinning.
It's a lot. And that's really our mission today, right? To cut
Eh,
through that noise.
Exactly. We need to figure out why the bond market is getting so nervous, why Microsoft and Meta are moving in completely opposite directions despite doing, basically the same thing.
And we have to talk about that aha moment of the morning because there's this fascinating paradox playing out with the potential new Fed chair.
Right, the self-proclaimed inflation hawk, who's suddenly the favorite.
And the market's reaction selling bonds aggressively is telling us a very specific and pretty contradictory story about what investors actually expect.
Let's start right there. That's the headline dominating Bloomberg and Yahoo Finance this morning. The Fed chair sweepstakes. We're expecting President Trump to announce his nominee, any minute now.
That's right. And for weeks, this has been a total guessing game. We've heard names thrown around like Kevin Hassett or Chris Waller. But as of this morning, the betting markets, specifically Polymarket, have shifted aggressively.
Aggressively is putting it mildly. I saw the odds for Kevin Warsh shoot up to something like 85 or 90% overnight. It went from a horse race to a coronation.
Correct. Kevin Warsh is the prohibitive favorite. And to understand why this matters, we have to look at who he is. He isn't a new face. He served as a Fed governor from 2006 to 2011.
So he was there for the big one. He was Ben Bernanke's liaison to Wall Street during the 2008 crisis.
He is a crisis veteran, exactly.
Okay, so on paper, that sounds reassuring. But here's where I'm getting stuck, and I need you to walk me through this. Warsh is known as a hawk. He's the guy who usually argues for tighter money, higher rates, and he dislikes big balance sheets.
Historically, yes. He has criticized the Fed's expansive use of its balance sheet that, $6.6 trillion pile of assets they're currently sitting on. He's a rule-oriented guy.
Okay, so if a hawk is coming in, shouldn't the bond market be celebrating? I mean, hawks fight inflation. Fixed income investors hate inflation. So why on earth are Treasury yields spiking this morning?
It's a great question.
The 30-year yield jumped 5 basis points. The 10-year is up to 4.265%. The market is dumping bonds. That just, it doesn't fit the hawk narrative.
And that is the paradox. You have to look at his more recent behavior. Warsh has, recently aligned himself with President Trump, arguing publicly for lower borrowing costs.
So he's flipped. Is that what the market is thinking?
The market suspects he might be flexible, and that terrifies bond traders. If you have a guy who historically loves rules but is suddenly advocating for low rates to align with the White House, the market starts to price in a loss of independence.
Explain that mechanism. Why does a loss of independence make my 30-year bond worth less?
It all comes down to the term premium, or you could call it the inflation premium. If investors think the Fed chair will keep rates low just to juice the economy for the president, they assume inflation will eventually roar back.
And if you're holding a bond that pays you a fixed 4% for 30 years and you think inflation is going to 5%.
That bond is garbage. You sell it immediately.
So the sell-off isn't really about Warsh the person. It's about the fear that he won't say no to the president.
Exactly. The strategists at Bloomberg called it a defensive measure. Investors remember the rule-following hawk, but they see the political reality. So they are demanding a higher yield, a higher return, to take on the risk that he might let inflation run hot.
It's fascinating. It's like the market is preemptively protesting the potential lack of friction between the Fed and the White House.
And then you have the currency angle, too. The dollar actually rose this morning, recovering from a 4-year low.
Which usually happens when rates go up.
Right. But it's also a growth signal.
Yeah.
If the market thinks Warsh and Trump are going to deregulate and pump the economy, well, the U.S. looks like a better place to invest than Europe or Asia, even if inflation is a risk. So you buy dollars, but you sell your long-term bonds.
So Warsh is the front runner. Were there any other serious contenders left, or is this basically a done deal?
Well, Rick Ryder from BlackRock was a strong name for a while, Kevin Hassett as well. But the prediction markets are usually pretty sharp on these things. That surge for Warsh suggests the decision's made, and the other contenders are just there for optics at this point.
Okay, so while the macro guys are having an existential crisis about the Fed, the tech investors are dealing with their own drama. The earnings reports from CNBC this morning show a massive divergence in the Nasdaq.
Oh, it really is a tale of two markets within the tech sector.
Let's talk about Microsoft versus Meta. Because if you just look at the headlines, they're doing the exact same thing, spending an absolute fortune on artificial intelligence.
Correct. I mean, both companies are in a massive capital expenditure cycle. They are buying GPUs, building data centers, upgrading power grids, everything.
But the stock reaction is just night and day. Microsoft is down about 10%. That's its worst day since October. And Meta jumped 10.4%.
It's a huge swing.
So why is Wall Street punishing Satya Nadella for spending money on AI, but throwing a party for Mark Zuckerberg for doing the exact same thing?
It comes down to the timeline of the payoff. Wall Street is getting incredibly picky. With Microsoft, there's growing concern about the Azure cloud business. It didn't perform quite as well as the Whisper numbers hoped.
The Whisper numbers, those are the unofficial targets that traders pass around, right?
Yeah.
Exactly. Microsoft missed that invisible bar. So investors looked at that massive AI spend and asked, okay, is this translating into revenue fast enough? It feels like they're building the railroad tracks, but the trains aren't full yet.
Whereas with Meta,
With Meta, the market sees the AI spend working right now. Mark Zuckerberg convinced investors that their AI investment is directly improving their ad targeting algorithms today. It's not a future bet. It's generating cash flow in the current quarter.
so Microsoft is, trust me, it's coming, and Meta's, look, it's here.
Precisely. And in a volatile market like this, cash today beats promises tomorrow. And you saw this broad skepticism hit other companies too. Datadog dropped nearly 9%.
I saw that. Was that also a spending issue?
That was a different fear. That's the fear that AI might actually take their business. The narrative is shifting from AI helps every software company to AI might replace some software companies. Investors are trying to figure out if Datadog is on the menu or at the table.
Speaking of companies definitely at the table, we have to talk about Apple. They reported what CNBC called blowout Q1 earnings.
They did. And they're predicting 16% growth for the current quarter. But Apple has what you might call a good problem.
Which is?
They literally cannot build iPhones fast enough. Tim Cook admitted they are supply constrained.
Now, is this the memory chip shortage again? I feel like we hear about that every year.
Surprisingly, no. Cook specifically said memory prices are skyrocketing because of AI data centers, but that's not the bottleneck for Apple. The bottleneck is advanced node manufacturing.
Okay, let's dig into that. When he says advanced node manufacturing, what are we actually talking about?
We are talking about the 3-nanometer chips, the A-series chips that run the iPhone. These are some of the most complex mass-produced objects in human history, and they're pretty much all made by TSMC in Taiwan.
So why can't they just ramp up production? Just run the factory 24/7?
Because the physics of it are just insanely difficult. To make a 3-nanometer chip, you are using extreme ultraviolet lithography. You're blasting molten tin droplets with a laser to create plasma that emits light, which is then focused by mirrors so smooth that if they were the size of Germany, the biggest bump would be a millimeter high.
Wow. Okay.
You can't just ramp that up overnight. TSMC is running at capacity. Apple needs millions of these chips, and the physics of the manufacturing process itself is the speed limit.
That really puts it in perspective. It's not a labor shortage, it's a technology ceiling.
It is. But here's a little nugget for you, especially if you're interested in the broader economy. Cook mentioned that Apple sourced 20 billion chips from the U.S. in 2025.
20 billion from the U.S.
Yes. They beat their target. Now, these aren't the 3-nanometer brains. Those are still coming from Taiwan. But for the other components, the sensors, the power management, the onshoring effort is actually real.
That is a staggering number. Before we leave tech, I saw a headline about OpenAI that kind of made me chuckle. They're retiring GPT-4o.
They are next month.
I feel like we just got used to it. People loved it because it had that warm conversational style. It felt like talking to a buddy.
It did. But OpenAI released the usage data, and it was brutal. Only 0.1% of users use it daily. The vast majority have already moved on to GPT 5.2.
It's kind of sad, isn't it?
Yeah.
We say we want AI to be human-like and friendly, but the moment a smarter, colder version comes out, We just dump the friendly one.
It just proves that utility wins. Users claim they want personality, but their behavior shows they want raw intelligence and speed. OpenAI isn't running a charity for lonely chatbots. They're clearing servers for the models people actually use.
RIP to the nice chatbot. All right, let's pivot to something that feels a lot less digital and a lot more physical, the commodities market.
Oh, this was a bloodbath this morning.
I was looking at the charts from CNBC. Gold and silver just fell off a cliff on Friday.
They snapped a powerful rally, and you have to contextualize this. Gold had gone from, what, $3,000 to $5,500 recently in what Ed Yardeni called a melt-up?
A melt-up? That sounds dangerous. What exactly is the psychology behind a melt-up?
It's just panic buying. It's when investors aren't buying because of fundamentals, they're buying because they're terrified of missing the move. It becomes a self-fulfilling prophecy. The price goes up, so more people buy, which pushes the price up further.
It stops.
Until it stops, and when it stops, it crashes. Gold plunged on Friday, silver fell even harder.
So is the party over? Or is this just a breather?
Well, you have a real debate here. Ed Yardeni says this is a normal correction. He thinks pulling back to $5,000 is healthy consolidation.
But there's a darker theory floating around, isn't there?
There is. Gregerson from Silver Bullion pointed out that the drop was, and I'm quoting, massive and abrupt. He's suggesting it might be intended.
Intended, as in manipulation.
He implies it looked designed to trigger further declines. In trading, we call this a liquidation break. If big players can push the price down just enough to hit the stop-loss orders of the retail investors, it triggers a cascade of automatic selling.
Like knocking over the first domino.
Exactly. And look, if you look at the technicals, the relative strength index, the RSI, was above 90 before the crash.
For the listener who doesn't stare at Bloomberg terminals all day, translate RSI above 90.
Think of a car engine. The red line is usually at 70. If the needle is at 90, the engine is screaming. The asset is incredibly expensive relative to its recent history. It's overbought. And when a market is that stretched, it doesn't take a conspiracy to knock it down. It just takes a stiff breeze.
So Standard Chartered is telling people to run for the hills.
No, and that's the interesting part. They acknowledge the crash, they acknowledge the technicals are overheated, but they are maintaining a long-term bullish stance. They still recommend a 6% allocation.
Their logic being?
They think the reasons to own gold debt, geopolitical instability, those things aren't going away just because the price dropped today. The world didn't get safer on Friday. The price just got cheaper.
Right. Before we leave markets, I want to quickly hop across the pond. It wasn't all red ink in Europe, was it?
No, Europe had some bright spots. Adidas shares jumped about 6%. They posted record revenues, almost 25 billion euros. And CaixaBank in Spain also beat expectations. So despite the gloom here, the European consumer is holding up, at least in certain pockets.
Good to hear. But now we have to bring it back home to Washington, D.C., where things are decidedly less functional.
Unfortunately, yes. We are staring down the barrel of a government funding deadline tonight, Friday night.
And Bloomberg is reporting that we are likely going to miss it.
That is the consensus, yeah. The issue isn't money generally. It's specifically about funding for ICE and Homeland Security.
This all goes back to the incident in Minneapolis, right?
Correct. The death of a U.S. citizen, Alex Preddy, during a confrontation with Border Patrol. It has just sparked a massive political firestorm.
It's become a line in the sand.
It has. Democrats are demanding body cams, judicial warrants for ICE, an end to broad sweeps. They are saying, we will not sign a check for this agency without these guardrails.
And a Republican response.
Senator Lindsey Graham has placed a hold on the bill. He's saying, we aren't handcuffing the agency. So we're at a total impasse.
So what does this mean for you, for the listener? Are the national parks closing tomorrow? Is TSA going home?
It looks like it will be a technical shutdown over the weekend. The expectation is that essential services will stay on. TSA will still screen you, and they will try to pass a 2-week stopgap for DHS next week. But for tonight, the funding lapses. It just adds another layer of uncertainty to an already nervous market.
And if that wasn't enough drama for the Capitol, we have a lawsuit that I frankly had to read 3 times to believe.
You and me both.
Sourced from CNBC, President Trump, his sons, and the Trump Organization are suing the IRS and the Treasury Department.
For $10 billion.
Let's just pause on that. The sitting president is suing his own Treasury Department.
Yes, it is completely unprecedented. The lawsuit alleges that a rogue IRS employee, Charles Littlejohn, who is now in prison, leaked their tax records to the New York Times and ProPublica.
Okay, the leak definitely happened. Littlejohn is in jail for it. But the optics of the sitting president suing the agency he oversees. I mean, isn't that a massive conflict of interest?
It raises incredible legal questions. Can the Department of Justice defend the Treasury against the president who runs the Department of Justice? It's a legal pretzel.
But the administration isn't just filing paperwork. They're taking action against the contractors, too.
They are. Treasury Secretary Scott Bessent canceled contracts with Booz Allen Hamilton.
That's the huge consulting firm that employed the leaker.
Exactly, and that is a huge deal in D.C. Booz Allen is a titan of government contracting. Canceling those contracts sends a chill down the spine of every consulting firm in the Beltway. It basically says, if your employees leak, you lose the contract.
It really is the perfect storm for a Friday. You've got the Fed chair race spooking the bond market, tech giants splitting apart, commodities crashing, and the president suing the taxman.
It is going to be a very, very busy weekend for news desks.
So let's try to summarize this whirlwind for everyone. What are the big takeaways from all this?
All right, big picture. Number one, the Fed. Kevin Warsh is likely the guy. The market is reacting defensively, sending yields higher because they fear he might prioritize the president's growth goals over fighting inflation. The bond vigilantes are waking up.
Number two, the tech divergence. It's not enough to just say AI anymore. The market is rewarding Meta for showing immediate profits while punishing Microsoft for building infrastructure that hasn't paid off yet. And Apple is stuck in a physics problem, just trying to get enough chips to meet demand.
Number three, the commodity melt-up is over, at least for now. Gold and silver crashed from record highs. Whether it was a natural correction or a liquidation break, the easy money has been made.
And number four, Washington is messy. A likely technical shutdown this weekend over border policy and a historic conflict-ridden lawsuit between the White House and the Treasury.
It is a lot of moving parts.
So here's a provocative thought to leave you with. We're seeing a market that's deeply conflicted. On one hand, it's rewarding Meta for spending billions. On the other, it's punishing Microsoft for doing the same. It's buying dollars but selling bonds. It's fleeing gold but wary of stocks.
It suggests that the easy trades of the last year are dead. The rising tide isn't lifting all boats anymore. You have to be selective. And regarding that gold crash, if gold was the safety trade against chaos, and chaos is clearly increasing, why is gold crashing? Is the safety trade over, or is the market just taking a breath before the real storm hits?
Something to mull over while you watch the headlines this weekend. We'll see you all Monday morning with new headlines from major financial magazines.